You are listening to Mining Stock Education.
I think that the combination of rising global demand for energy, oil and gas, a rollover in global non-OPEC supply, limited OPEC spare capacity, I think we're sleepwalking into an energy crisis. I don't think it's something you're going to see necessarily in full this year, 2026, but I think you certainly will in 2028, 2029, 2030.
Welcome to Mining Stock Education. My name is Brian Leni. Today with me I have Elliott Gue, editor and chief analyst at the Energy Bulletin. In our conversation today, you will hear Elliott's views on the current geopolitical landscape and how it's affecting energy markets, tech's future demand for energy, where the best opportunities are, and a couple of his top picks. Elliott, it's great to have you back on the show. Let's start
Thanks
with
for having me.
Oh, you're welcome. Let's start with arguably the biggest headline involving the oil market over the last couple months. The U.S. goes in, ousts Maduro from Venezuela, open the door, for the world market to sort of come in there. Given its massive reserves, when you strip away the politics and focus on purely, on the basis fundamentals as an oil investor, how should we be thinking about Venezuela today and moving forward?
Yeah, I think Venezuela is deeply misunderstood in the mainstream media. There's all this talk about the world's largest reserves, but the truth is that those are mainly a paper asset. If you look at Venezuelan reserves, go back to the 80s, 90s, up until about 2010, they ranked way down the list. And the reason they have the world's largest reserves now is that Hugo Chavez basically pushed hard within OPEC and outside to have a lot of the heavy oil reserves they have in the Orinoco Belt reclassified as proved reserves. And he did this in the late 2000s, so 2008 to 2010, and they went from way down the list in terms of global reserves to the number one in the space of 3 years, simply through these revisions. However, right, they did work with some foreign partners, right? But they were Russian and Iranian companies that did a lot of the reclassification work there. And, it was done based on oil prices at that time, way up around, $80, $100 a barrel back then, those dollars, right? So, it was a blatant political move within OPEC to make Venezuela look more important. And it was a national prestige thing. And it was 100% self-reported, as it is today. So this is PDVSA, the Venezuelan National Oil Company, tells everyone that they have the world's largest reserves, 300 plus billion barrels. So they do, magically. The reality is, up until that time, Saudi Arabia had the world's largest reserves. And so it was just sort of an overnight paper political thing. So this number, though it's bandied about all over the media, I'm sure Hugo Chavez would be delighted. Obviously, he passed away a long time ago. But I'm sure he would be delighted to see, the Western media just sort of aping this figure, this $300 billion figure, with no real facts or basis behind it. The second thing I think it's important to understand is that a country's production and reserves aren't necessarily that closely related. The U.S. proved reserves ranks down, I think, around 8th or 9th worldwide, way behind Venezuela, Saudi Arabia, Canada. It's also the world's largest oil producer. Canada ranks number 3, I believe right now, behind Venezuela and Saudi Arabia on most of the league tables. But their production is roughly half what the U.S., a little less than half what the U.S. produces. So, there really isn't a direct link between these reserve numbers we keep hearing about and what Venezuela produces today. They're producing less than 1 million barrels of oil a day, which is less than 1% of global supply, despite the world's largest reserves. Even if we go back to the late 1990s, before Hugo Chavez became president and sort of basically started gutting the industry, they were still producing 3.5 million barrels of oil a day. So a fraction of the U.S. at over 13 million barrels a day today. So I think that this idea that there's going to be this huge flood of global oil supply, or the U.S. has seized this massive global crown jewel asset, is overstated. I think that with lots of investment, right, you could actually see Venezuelan oil production rise. So I think, with, around $10 billion are the estimates I've seen, which makes sense. You could repair, the broken pipes, the deeply damaged infrastructure, the mismanaged wells. Remember, Hugo Chavez started basically firing a lot of the experienced managers at PDVSA more than 20 years ago, back in 2003, in early 2003. And then the actual nationalization of the industry, happened later in 2007. But for all this time, their industry has been basically mismanaged. And so a lot of this infrastructure needs to be repaired. A lot of these wells need to be worked over, basic maintenance that really you need foreign capital to do it. I'm talking, again, $10 billion. Maybe that gets you up from under 1 million barrels a day. Maybe that gets you up 500,000 barrels a day from that low. To go beyond that, you have to you're talking about drilling new wells, exploiting new pockets, new reserves, if you will, within the Orinoco Belt, which is where most of Venezuela's growth would come from, this extra heavy oil. And that is difficult to produce. You also need to build new facilities to upgrade that oil so that you can actually, flow it through a pipeline onto a tanker and ship it somewhere, probably the United States, right? So this is, you're probably talking about upwards of $100 billion in investment to do all that. And you're talking about 5+ years at a minimum. And, that's after the situation there is stable enough to warrant that level of investment. So, I think I think that, the media immediately seized on Chevron as being an obvious play, which I suppose to an extent it is. And I have nothing against Chevron. In fact, we like it. But, because they were the only U.S. major producer that stayed in Venezuela after the industry was nationalized. So they accepted a minority stake in, Venezuelan oil projects behind the national oil company, PDVSA. And they pump, I think, somewhere around 200,000 to 250,000 barrels a day there still when everything is operating. So they do have kind of an inside track. They've been there all along. Exxon, Conoco, Total Energies, a lot of the other big foreign or Western producers left. However, yes, they can probably do some repair work and increase their production a little bit. But the idea that this is going to be an overnight windfall for them is insane. You're talking about years of investment ahead just to get back to where they were, say, in 2018. And so, yeah, they're a likely leader, but it's not a near-term positive for them. Exxon, which a lot of people thought would be disadvantaged relative to Chevron because they left the country. They do have some claims there, but they're relatively small in terms of actual fines against the PDVSA or for nationalizing the assets. Conoco is the other one a lot of people thought would benefit because they have huge claims, $11-12 billion in claims against PDVSA for having their assets seized. But again, Exxon doesn't really care. They're more interested in neighboring Guyana, where they have this massive offshore oil project, deepwater oil project that has very low costs of production, and they're already ramping up in stages. They're going to put their money there, I would imagine, not going back to Venezuela for the third time since the 20s. And having had their assets nationalized twice, you could forgive them for probably not being particularly interested in running right back in. And so I think that, the story for the big for the oil supply and demand is minimal near term. For the big oil producers, it may be a tailwind, but you're talking about 5-6 years hence. I think the big winners near term are your refiners, right? In particular, we like Valero Energy, symbol VLO, because U.S. refineries, particularly on the U.S. Gulf Coast, are set up to refine Venezuelan crude oil, that heavy, sour crude oil. So heavy oil, a little more difficult to refine. You need additional steps. You need a lot of hydrogen to crack and break the long molecules of oil into usable products. Sour just means it's high in sulfur content. So that has to be removed before it can become, gasoline or, imagine that, right? Ultra low sulfur diesel, right? They're capable of refining that here. We are capable of refining that here in the United States. In addition, you need diluent, which is basically naphtha or a very light oil that you can mix with the Venezuelan heavy crude to help it flow into a pipeline and onto a tanker. Well, we have that in spades because shale production is very, very light. We have a lot of natural gas liquids. All of this stuff can be used as diluent. So it's a natural pairing, right? The U.S. has lots of diluent and needs more heavy oil because refineries are actually set up to refine a mix of light sweet crude oil, which we have in abundance in the U.S., and that heavy sour crude. So if they're only forced to refine very light grades of crude, they're not using all their equipment, which back in the 90s and early 2000s, they spent billions of dollars putting in infrastructure. And so, and they're also not as efficient in producing particularly distillates like diesel. So, that heavy oil, they can buy at a discount on the global market. It always trades at a discount or almost always trades at a discount. But in recent years, that discount's been very small because Venezuelan crude hasn't been available to your U.S. Refiners. They've been forced to pay up and compete with China for Canadian barrels from other parts of the world, Iraq being another one, for example. So the availability of Venezuelan crude is a new choice, a new source of deeply discounted heavy sour crude they can use to fine-tune their refineries. So I think that your complex refineries with heavy Gulf Coast exposure like Valero are the big near-term winners. A little longer term, I think the services companies are the better play than the big oils on Venezuela because, they're the companies that are going to go in there. Services companies don't produce oil and gas. Their money comes from the CapEx budgets of Chevron, Exxon, BP, Shell, you name it. So if those companies are really going to go in and spend all this money in Venezuela to upgrade to build new upgraders, to start new projects, to develop new reserves, guess who benefits from that? Schlumberger, now called SLB, Halliburton, etc.
Right. When it comes to the differential between heavy and light or sweet crude, what sort of differential are we looking at or profit margin, at these oil prices? Like, obviously they're still making money with the heavy crude, but is there that much of a difference in the pricing?
Well, there has been. Historically, it trades at a pretty deep discount to your international grades like Brent or your US WTI. And the idea was back in the 90s and early 2000s was that global oil supply was getting, heavier and more sour, right? And so a lot of refineries worked on that assumption and built out all this capacity to handle heavy sour crude. Next thing you know, along comes shale. Shale is light sweet crude oil, and a lot of it's ultra light sweet crude oil. In fact, the EIA, the Energy Information Administration, breaks down U.S. oil production by API gravity, which is basically a measure of how heavy it is. And that ultralight and light crude oil is growing very rapidly. And those heavier grades are declining in terms of U.S. production. Actually, physical volumes are declining. So what's happened is you have some nearby producers for that heavy sour crude oil. You have Canada, right? Canadian oil sands. You have Mexico, Maya, right, is a heavy sour crude. And then you have Venezuelan, several grades of Venezuelan crude are that heavy sour crude. You also have in the Middle East, you have Iraq, you have Iran, you have a couple other producers, but a lot of those have been, disadvantaged. Mexico has been using a lot more of their own heavy sour crude and have been exporting less. So that kind of takes Maya off the market for the U.S. producers in recent years. Canada, yes, they're still producing, they're growing. They have a well-run energy industry. But you have China also wants that heavy sour crude, right? So they're kind of competing with the U.S. for Canadian barrels. You have Canada going over to China recently to encourage more exports of Canadian crude and gas to Asia, to China. And of course, the Iranian barrels is more of a story for China. The U.S. isn't going to be importing those. Russian barrels of heavy sour crude as well are going to be off the market for a lot of the world. So you have seen this thing where it's still trading at a discount, but the discount is narrowed to just a few dollars a barrel from, at times $5, $6, $7 a barrel historically. And so I think if we start to see more Venezuelan crude come into the market, you're going to have these U.S. refiners buying that crude at a, $5, $6 a barrel discount to WTI or Brent, right? And actually optimizing their refinery production using that heavy sour crude, which they're extremely capable of refining, particularly when it comes to distillate fuel, diesel, heating oil. A lot of military fuels are middle distillates. So all of this is in high demand. It's actually demand for that's actually growing faster than demand for gasoline globally. So, this is an advantage for them. They get to buy this oil at a discount, refine it into diesel fuel, gasoline, whatever, which trades at full global market prices. You have, U.S. refiners being called on to actually refine oil for foreign countries as well. You have Europe shutting down a lot of their refinery capacity, the United Kingdom as well. They recently shut down a couple more refineries there. So they have very limited refining capacity in the UK now, down tremendously over the last 10 years. And so they're importing more oil or more gasoline, distillate, diesel from the United States. So I think the refineries are kind of in the catbird seat in the short to intermediate term because they're able to buy that oil at a deep discount and, produce these fuels and sell them on the global market at high prices.
As an investor, when you look at what's gone on with Iran over the last, let's say, 12 months, the back and forth, the social unrest, where does it rank in terms of your concerns of how it might affect the oil market?
I generally think that political and geopolitical arguments in oil and gas are overdone. Oftentimes, for example, last summer we had the airstrikes in Iran, and you saw oil spike, and it immediately gave all that back. A few years back in 2018, you had these attacks on Saudi Arabian oil facilities. You actually had a big chunk of Saudi Arabian oil capacity, production capacity taken offline for over a week, right? A couple of weeks, really. And yet, oil prices spiked and came immediately back down. Geopolitical events, despite what you may have heard, tend to have very short-term and transitory impacts on the global oil market. And, I've been covering the energy industry specifically in depth since the 90s. And I've seen more money lost in my career on geopolitical and political arguments than anything else. Even more ridiculous, I think, than the geopolitical arguments is the U.S. national political arguments, where, you have, Donald Trump, drill, baby, drill. It didn't result in more drilling activity in the United States. You have these oversimplified, overstated issues. You had people saying back in 2016, renewable energy stocks are going to do badly because Trump was coming in. Renewable energy stocks outperformed oil and gas throughout his entire first term. When Biden came in, he said, this is bad for a lot of people said, this is bad for oil and gas and good for renewables. Renewables were down sharply. Oil and gas stocks had their best years in a long time. A lot of this geopolitical and political issues are on the margin. They're not really what's impacting, I think, global oil supply and demand balances. With the Iranian situation, you have something very similar to what you have in Venezuela. A lot of that infrastructure there is badly damaged. If Iran ever were to say open up to foreign investment again, no longer be sanctioned, it will take years to bring production back up and billions of dollars of capital. What we've seen with Iranian barrels is they mainly have been going to China, and China has been using them to build its strategic petroleum reserves at cheap prices. I think the bigger issue longer term is right now, the world is very focused, or a lot of people are very focused on a short-term oversupply of oil in the global market. You have OPEC increasing production, or basically rolling back cuts they made in prior years, from 2020 up until 2024. You're seeing them roll back those cuts, and you're seeing, U.S. oil production growing. And you're seeing a lot of talk about some of these new plays like Guyana, right, growing. But the reality is that, OPEC's spare capacity, which is basically capacity that they're holding off the market, but could bring to bear if need be. So Saudi Arabia, for example, has 12 million barrels a day plus of production capacity, but, is only producing, let's say 10, right now. So they have some millions of barrels a day they could start producing if they wanted to or needed to. But the reality is that Saudi Arabia and a couple other countries in OPEC are the only ones with real spare capacity. A lot of the other countries, their official quotas bear no resemblance whatsoever to their actual ability to produce. Nigeria, all these countries in Africa, for example, their infrastructure they've not produced anywhere near their quota in many, many years, and well over 10 years. So I think that the bigger story in the intermediate term is that you have, OPEC spare capacity is low, right? And global oil demand continues to grow. Despite what the IEA and others said a few years ago, global oil demand is still growing every single year. The Chinese economy is actually becoming more dependent on oil, not less dependent, right? Overall, oil, gas, and coal account for more than 88% of China's energy demand. If I add in nuclear and hydro, right, it jumps to over 94%. So renewables are not displacing a lot of Chinese oil or natural gas demand. So you have growing demand, you have limited spare capacity within OPEC, and then you have this non-OPEC production growth. But the reality is that doesn't make sense at, $58, $60 a barrel. You saw just last week, Harold Hamm, whose company Continental Resources is now privately held. They're a big driller in the Bakken Shale of North Dakota. He suspended drilling activity there because prices are too low for him to make good money, a decent return on his investment, a risk-adjusted return. You have in places like the Permian Basin, the core of the Permian Basin, yes, you can make money at $50 a barrel oil, but that doesn't mean you're going to drill as aggressively at $50 and make a much lower free cash flow than you would at 70 or 80, say. So why are these companies going to drill through all this inventory they have, right, of drilling locations at $58 a barrel when they could wait for oil prices to go back to 70? The only reason we're seeing a lot of growth in U.S. oil production, or any growth in U.S. oil production, is basically New Mexico and the Gulf of Mexico, or Gulf of America, as if you prefer. So the Gulf of America production growth is coming from longer term projects. New Mexico is basically Exxon, and they have some longer term projects that they're developing there, and they're trying to get up to a plateau level of production and sort of hold it there. And so they're kind of in this manufacturing mode. But I think that's obfuscating under the surface, which is a lot of other companies likely cutting back this year. And I think we're going to actually see a decline in U.S. oil production this year. So, I think the bigger story longer term is what we call the base decline rate. So what that means is that mature wells around the world, fields around the world, see declining production as the natural subsea pressures in these wells or subsurface pressures of these wells decline, production rate declines. And that's accelerating. The IEA put out a study, I think it was back in maybe September, where they updated a study they did, more than 10 years earlier, I think 15 years prior to that. And they showed a big acceleration in global non-OPEC base decline rates, particularly. So a lot of these fields in the deep water have even higher than average decline rates. So that means every single year, right, if companies don't go out and find new fields, invest in new production sources, global oil production will start to roll over. especially outside OPEC. And so I think the combination of, I think that the combination of rising global demand for energy, oil and gas, a rollover in global non-OPEC supply, limited OPEC spare capacity, I think we're sleepwalking into an energy crisis. I don't think it's something you're going to see necessarily in full this year, 2026, but I think you certainly will in 2028, 2029, 2030. And it could be every bit as bad, if not worse, than what we saw back in, say, 2008, where, OPEC was producing flat out and oil prices really started to melt higher. So I think that we have another wave of this energy cycle coming, because without a lot of investment in new field production, you're going to see a shortage and price spikes in oil and to some extent in natural gas as well. And it's coming. And I think one of the reasons why there are a lot of reasons that have nothing to do with oil. The U.S. did what it did in Venezuela. But I think one issue is that if we do see an increase in Venezuelan oil production, it would be in that time frame, that late this decade, early next decade, which is exactly when I think the world is going to really need more oil production. And I think the United States is going to want as much oil production as possible close to home to feed refineries with this heavy sour crude. So I think that is you could make the argument that thinking ahead, that's another reason why, Venezuela is of strategic importance to the U.S. specifically.
Right. And it's also happening in conjunction with technology's rise, AI, Bitcoin,
Yes.
crypto, like all this big tech requires a huge amount of energy. And it looks like that's only going to become a bigger part of our lives moving forward. And you can say to what degree. But from my perspective, you look at tensions, the possible deglobalization, whether it's tensions with China, Russia,
Mm-hmm.
whoever, there seems to be a race towards AI and how it militarily sort of unfolds. And, you see China that's not as afraid of being politically incorrect. Like you said, 88 or 89% of their production is focused on maybe fossil fuels.
Yes.
Whereas the West has definitely taken a step in the other direction. So it would almost seem that it's inevitable that, fossil fuel consumption has to go up to sort of keep up with what's going on. Would you agree with that?
Oh, yeah, I think so. And you have China, and yes, they are building out rapidly, for example, their solar capacity. But I think a lot of people, China's own energy policy, what they call it, right, is build first, break later. I won't butcher the actual Chinese for that. But basically, they don't call their own energy policy an energy transition. They say, build first, break later, or destroy later, depending upon how you translate it. But the idea is that they're not transitioning in the sense that they're not building out all this solar capacity and then closing down coal-fired plants, right? They're building it all. It's an all of the above strategy. And if there comes a day when they feel that they can close some of their coal-fired capacity, gas-fired capacity, and rely more on renewables or nuclear or something else, they could do that. But they're not doing that right now. If you go back to 2019, for example, right before COVID, Chinese energy demand in exajoules has grown over this time period. More than 70% of that growth has been enabled by oil, gas, and coal. So it's not even that their entire energy system is set up 88% for oil, gas, and coal. It's that their growth is coming from oil, gas, and coal. Renewables rank down below nuclear. And then you have beyond China, let's look at India, right? Every developed country in the world today, right? Like China, which is not really an emerging market as much. It's sort of transitioning to a more developed economy. They went through a period of very rapid energy demand growth. When people achieve a certain level of wealth, energy demand growth skyrockets. It happened in the United States, obviously. It happened in Japan, happened in South Korea, right? Every country. And India is basically, in my view, today, like China was in, say, the early 2000s. and they're hitting that rapid growth. So you have people in India who are still cooking over wood fires. A lot of people, in outlying areas. And, they're trying to switch them over to natural gas. You have an unreliable electric grid in India. They're upgrading it with brand new coal-fired plants. So even if Chinese demand for oil begins to slow, and it's not right now, in 2014, China got approximately 25% of its energy from oil and natural gas. Today, it's over 30%. So their dependence on those two fuels alone is actually growing, not declining. I think in 2019, it was like 29%. So we're over 30% now. So it's even on a short time frame. And this data is through the end of 2024. I don't have the 2025 full data, but, you're definitely seeing an increase or at least a stable growth in demand in terms of the percentage of their overall energy demand. But, even if their demand growth does slow down, as for example, it did in Japan, as for example, it did in the United States, as these economies grew and developed, you have all these other countries like India, huge populations that are on that same growth track. So I do think you're right. I think there's going to be a lot of competition worldwide for these crucial energy commodities. Renewables, a lot of people are still living in this pipe dream that they're going to be able to take over, and they're not. Even China isn't transitioning. They're growing. Coal is by far, a more important source of growth in their electricity production than renewables in absolute terms. And so I think that's definitely the case. I think you're going to see more competition for these assets. Different countries are going to make different choices. China doesn't have enough oil. They import, 74 to 80% of their oil. I think 74% of their oil, 80% of it comes through, one strait, is imported through one strait in southern China, which means that, their imports of oil are vulnerable, which is why they're building up this huge strategic reserve. Natural gas, obviously, have to import a lot of that as well. They do have coal in abundance domestically, which is why their economy relies so heavily on it. The United States, we have coal, and coal will remain a part of the U.S. electric grid for some time to come. In fact, throughout most of last year, it was the fastest growing source of electricity in the United States. But natural gas, I think, is the key in the U.S. Because, it's a cleaner fuel than coal. We do have it in abundance, and we can produce it even at $4 a million BTUs, I think is a good long-term price assumption for gas. It's a fraction of what it costs in Europe. And that's enough to keep, the rigs producing in places like the Haynesville Shale of Louisiana. And so I think that's an obvious source of U.S. Growth in electric capacity. Nuclear, yes, longer term, but, a lot of people talk about nuclear, but nuclear takes time. Natural gas, I think, is the key U.S. energy commodity in terms of electricity and AI, right, over the intermediate term. And you're seeing that, right? You are seeing, for example, EQT in the Marcellus Shale of Pennsylvania, for example, the Appalachia region. They are signing deals to supply natural gas to coal-fired power plants that are being converted to natural gas, and they're going to be used solely to power AI data centers in that area. You're seeing it in Texas. You're seeing it all over. And you're going to see more of that. You're going to see more of these big tech companies nailing down supplies of U.S. natural gas because they need that always on, always available power. And they're paying premium prices for the gas because they need to guarantee reliable supply. It's not as price sensitive. It's more about 24/7 reliable energy. Different countries are going to make different decisions, but all these commodities are going to be of increased importance. AI just accelerates the matter. And then, of course, I think a big story for U.S. as well as LNG exports. Europe needs more natural gas. For them, it's also the only clear longer-term choice. Over-reliance on renewables in places like Spain, it's caused a lot of problems lately. Germany as well, high power costs. So, there's going to be a lot of demand for U.S. LNG. I think the global LNG trade is booming. And I think that'll continue to be the case over the intermediate to long term. Natural gas in the U.S., I think, is a great market. I mean, I think you can play it through the upstream names. I mentioned EQT, Expand Energy, the old Chesapeake is another example. And then, of course, the midstream as well, companies that own the pipelines to transport this gas from wells to market to these new LNG export facilities being built on the U.S. Gulf Coast.
Talking about renewables and sort of where they fit in and the slow adoption, I would say, well, I maybe I shouldn't even say slow, but it would, in the terms of its importance right now, it's definitely on the lower end.
Right.
Grid scale storage would seem to be what the ultimate cap is for the renewables. Mm-hmm. Where do you see grid scale storage at? Like, how close are we to having something that's reliable, cost effective?
It's okay. So you have places that are doing a lot of that. For example, California, they also tend to have very, very high prices because it's extremely expensive. And, building batteries large enough, right, to actually offset the need for generation is extremely expensive and extremely complex. And I think we're many years away from that. That's why you're seeing a lot of countries that don't actually do grid scale storage as much as they're doing natural gas backup, right? Shadow capacity, we call it. So in other words, when the sun isn't shining, the wind isn't blowing at an appropriate velocity, right? To actually output power from these plants, they're backing up with natural gas. These natural gas peaker plants can feed power into the grid when it's needed. I think parts of the U.S., like California, are going to have problems in the future because they're closing down too much of their reliable baseload power. They're getting too renewable dependent, and that's a recipe for high power costs and disaster. It's interesting with the United States. I think a lot of people talk about the U.S. like it's this one monolith pursuing a single policy, but that's actually not true. The U.S., you have to look state by state. Okay, so you have some states that are following the European sort of energy transition model. You have other states that are following more of the Chinese build first, break later model, right? California is following that transition model, and they have very high power costs because of the cost of building out, grid scale storage, and because they're not just building out all this renewable capacity, they're actually closing down a lot of their base load. They've eliminated coal basically from their grid, though they still import power from states that produce power using coal. Natural gas, even, they're declining capacity there. Look at Florida, where I live. Florida is more of that build first, break later. Our power demand here in Florida growing very rapidly. We have a lot of people moving here. But at the same time, we are closing down some of the older coal-fired facilities, but we're growing our natural gas very rapidly to offset that. And yes, we're one of the fastest growers in terms of solar capacity in the entire U.S. So we're building renewables and gas at the same time. And therefore we have power, even though Florida produces essentially no natural gas, no oil, nothing, right? Like domestically, if you want to call it within the state, in state. Whereas California was once one of the largest oil producers, still is a large oil producer within the United States, and also has a lot of natural gas reserves. But because we're building both baseload capacity with gas, as well as building out renewables, our power costs are slightly below the national average, whereas California's are among the highest in the lower 48. And so I think that renewables can play a role. I think you'll continue to see growth and build out of renewable capacity. But the idea that we're close to in the US or in China, because a lot of people are saying, the US is falling behind China in solar build out, but they're completely ignoring the fact that they're actually building out coal and gas much faster than renewables in terms of absolute energy output. Capacity, generating capacity is next to meaningless, because obviously your solar plant isn't generating all day and all night long, right? At the same rate that it does, on a bright sunny day. Same with wind speeds. So, I think that renewables can play a role. I think they'll continue to grow. I think there are opportunities there in some sectors. But the core of the global energy system for a long time to come, I think decades, is going to be, again, the big three, which is going to be your coal, your oil, and your natural gas. I mean, it's true in China. It's true in the United States. It's true in Europe. The only reason that they're renewable, first of all, they have very high power costs in Europe, but also, their electricity demand is actually declining because they've lost so much heavy industry in Europe in recent years due to those higher energy costs. And so I think Europe has some very hard decisions to make. I certainly don't envy it. I think some countries in Europe could do some things to improve their situation. The United Kingdom, I know it's not part of the European Union, but the United Kingdom is one of them. But, right now they're not. I do think they will in the future. But renewables are going to be on the margin of the global energy system for some time to come, despite all the hype.
Moving on to the equities, when you're looking at placing money in the market, do you have any criteria that you're prioritizing over others? Like, is it value, dividends, income? Like, how are you breaking down what to put your money in?
Well, a big part of it for us has always been where we are in the cycle. So in my view, we are in the midst of an energy super cycle that started back in 2020. Like every super cycle, we have periods where things are kind of booming. 2021, for example, 2022, and then periods where, things are less booming and people are actually talking about, low oil prices, low gas prices. But generally speaking, I think we're still on that track. I think commodity prices saw a generational bottom back in 2020, and usually these cycles last more than 10 years. I think it's likely to continue well into the coming decade. I think oil prices need to be higher over that period. The companies that typically benefit first from your higher commodity prices are going to be your actual producers, because these companies benefit most directly from rising commodity prices. So right now, because we think we're kind of in the early cycle for this next wave of the cycle, we've had a lot of upstream exposure. So on the gas side, natural gas side, I would look at primarily the lower cost U.S. shale producers. These are companies that can actually produce profitably with very low gas prices, say down in the low $2 range. They can wait out and ride through periods of low gas prices, which we see based on weather events, for example. But they also can ramp up to benefit from increased LNG exports, increased gas demand over the intermediate term. So as I mentioned, a name like EQT produces from the Marcellus Shale, very low production costs, sub $2 a million BTUs. There's their break even. And they're driving that down through their acquisition of Equitrans, which was their midstream unit, pipelines, processing plants, et cetera, right? By bringing that in-house, they made this acquisition. A lot of people thought it was a bad deal. Stock's up a lot since then because they're actually able to use their ownership of those assets to drive down their costs, right? And also increase their markets. So because they have access to pipelines, they can move natural gas out of Pennsylvania, Appalachia to the, Gulf Coast, where a lot of the export terminals are located, to places like Virginia, where a lot of data centers are being built. We're down here to Florida, where, we need it in summer for air conditioning, right? A name like Expand Energy is a combination player, right? They have assets in Appalachia and Marcellus, very low production costs, and they also have assets in Haynesville Shale of Louisiana, which gives them easy access to the Gulf Coast export markets. A little higher cost of production, but they're bringing that down rapidly. The next phase usually is the services companies. As I said, services companies don't make money off rising oil and gas prices. They make money when the upstream companies start spending more, right? So that CapEx is their revenue. So I do think we're entering a new exploration cycle in the next few years that's going to last well into the 2030s, because we're going to need to develop these new sources of energy. There are only a handful of players on the global market that are pretty dominant, like SLB, formerly known as Schlumberger. I also think that you want to look at the midstream names. On the upstream side, I'd also say on the oil side, often the first to move are going to be your big players. They're the most stable companies. They offer nice dividends in many cases, and they also have very low production costs. So, our favorite is ExxonMobil. Not very creative pick, but one that's done very well and has actually outperformed Chevron and all the European majors over the last couple of years. So I like the fact that they are on the leading edge of this exploration cycle. A few years ago, a lot of people were telling them that, Guyana was a waste of money. Now it's actually probably the most exciting non-OPEC oil and gas project in the world we've seen in the last 20 plus years, this decade or this century. So, beyond that, I think you want to look at some of these niche plays in other sectors. On the midstream side, you want companies that have the infrastructure to move oil and gas out of these key plays like the Permian Basin. Those have very high distribution yields, which is great if you're more of an income-focused investor. I would mention a name like Energy Transfer, for example, symbol ET. And then you have within refining, for example, you have this heavy, light oil discount play. The key there within that sector, I think, is location. Where are their assets located, right? Valero, most of their refineries are located on the U.S. Gulf Coast, Texas particularly. And that is going to benefit from that Venezuelan crude coming up, short distance, low cost. But they have very complex refineries. So they can refine oil from Africa, oil from South America, oil produced domestically. It all comes together right in the Gulf of America. They can also export anywhere in the world where margins are highest. So the answer to your question kind of differs from sector to sector. Right now, I think we're at the stage of the cycle where I like the upstream and sort of niches within the other areas.
Excellent. Ellie, can you tell us more about your newsletter and where people can find you?
Absolutely. Our flagship newsletter for many years now, we started back in 2012, is Energy and Income Advisor, energyandincomeadvisor.com. But if you're interested, we just started a service on Substack called the Energy Bulletin. So go to substack.com, and there's a service there called Energy Bulletin. You can look it up under my name as well. And it actually, we cover all the same markets in Energy Bulletin we do in Energy and Income Advisor. The difference is we offer a lot of free content there on Substack, talking about some of the issues we've talked about today, some videos. I try to put out 1 to 2 free pieces of content every week. So if you're interested in seeing what we're seeing in energy, seeing our thoughts on things like Venezuela, we put a lot of content up there, and that's available for free. If you are interested in diving a little deeper into actual stock recommendations, we do offer the Energy Bulletin Top 10 model portfolio there, which we offer a free trial to that paid tier if you'd like to check it out, where we have our top 10 favorite energy stocks at any given time. And we draw from all these areas. We have a lot of midstream. We have some of the names I mentioned today on the upstream side, both oil, gas, coal. We even have some alternatives when we see opportunities there, nuclear when we see opportunities there. So I think that's a great first step, an ideal first step if you want to just sort of see our research and check it out first and get some of our sort of macro thoughts on the industry.
Excellent. Elliott, thank you so much for coming on the show. Really enjoyed the conversation. We'll have to get this again soon.
Anytime. Thanks so much for having me.